Hi, this is Andy Filipiuk in Toronto for the week of June the 1st. As of the end of May, our Canadian permanent portfolio is up to around 2.5% year to date. It's been a very difficult year. We've seen interest rates shoot up quite dramatically globally. We've had gold and silver not really hedging the inflation component, and it's been a tough currency movement against us. We have 60% of our Canadian permanent portfolio priced in US dollars, and the Canadian dollar is up 5.5% year to date against the US dollar. So that's put some pressure on us. Interestingly enough, the preferred share that is 15% of our holding is up over 20% this year, largely because of the makeup of the preferreds that are in there. As interest rates rise, so do the value of these preferreds because they get reset every 5 years at a higher rate. So all in all, at 2.5%, I'm very pleased with the performance, and I expect to do better in the second half, largely because I think this inflation situation is going to continue for a while. And speaking of inflation, last week I talked about how difficult it is for the banking system in the US to handle all the new cash that's coming in. However, this is going to be secondary to the fact that the US government is going to be running about a $5 billion budget, which means there's going to be trillions in deficits this year like last year. And the only way to effectively pay for that is to have the Fed monetize it, meaning the government has to go to the market to raise the money for the deficit. The market is nowhere large enough now to buy US bonds at such a low rate. There's not enough interest in them. So the Fed is going to have to do that. So while there's lots of talk now because the economy is coming back with the COVID restrictions being lightened up a little bit, that the QE may subside, but I don't think that's going to be the case because the government is becoming a larger and larger percentage of the GDP of the US, and these deficits must be financed. So that will likely continue. Thanks for watching.